Hello and welcome. If you advise non-resident clients, especially in sectors like aviation or oil and gas, you know just how complex profit attribution can get. Well, today we're diving into a really game-changing provision in the new Income Tax Act 2025. We're talking about Section 61. Let's break down how this presumptive tax scheme can make compliance a whole lot simpler for your clients.
Okay, so let's start with a practical puzzle, something you might actually face. Picture this. A non-resident company is providing services for oil exploration right here in India. Now, figuring out their exact net profit from just the Indian operations, well, that can be a massive headache, right? It means complex allocations, digging through global financials. So how does the tax code handle this?
Well, the answer lies in a concept called presumptive taxation. You see, the new Income Tax Act of 2025 is really built on this idea of simplifying the tax code. And Section 61 is a perfect example of that principle in action. It's all about providing a clear, straightforward path to compliance.
So here's our game plan for today. We'll kick things off with the core concept, and then we'll really get into the weeds and decode Section 61 itself. We're going to look at who it applies to, walk through a case study, cover some critical compliance points, and then wrap it all up with the key takeaways you'll want to remember.
All right, let's get into the mechanics of it. What does Section 61 actually say? This is the heart of the provision, so let's take a closer look.
So, what is presumptive taxation, really? You know, the easiest way to think about it is like a prefix menu for taxes. Seriously, instead of a super complicated a la carte calculation of every single expense and revenue item to get to a net profit, the law just says, look, we'll presume your profit is a fixed percentage of your total revenue. That's it. It's simple, it's predictable, and it just cuts out a ton of that complex accounting work.
And this table right here, this is the absolute core of Section 61. It lays everything out so clearly. The 3 specific businesses it applies to, the fact that the taxpayer must be a non-resident, and of course, the most important part, the deemed profit rate for each one. It's all right there. Let's break down these rates one by one.
First up, for any non-residents who are providing services or facilities related to mineral oil exploration, the law presumes their profit is 10% of their gross receipts from Indian operations. You just take the total amount they received, apply that 10%, and boom, that's your taxable income.
Next, for non-resident airlines, the deemed profit rate is even lower, down at 5% of gross receipts. And this applies to all the revenue they earn from carrying passengers, mail, or cargo that originates from any place in India.
And finally, for non-resident shipping businesses, the rate is set at 7.5%. Now, it's really important to note that this applies to the aggregate amount, whether that money is received in India or somewhere else, as long as the freight originates from an Indian port.
Okay, and this slide? This is where you can really see the new Act's philosophy in action. It's all about simplification. You see, under the old 1961 Act, these rules were all over the place, scattered across different sections like 44BB and 44BBA. What Section 61 does is just pull them all together into one single streamlined provision. And look, this isn't just about making the law book look tidier. This is about providing certainty. For any foreign investor looking at India, this kind of clarity is huge. It reduces ambiguity, it cuts down on potential litigation, and it just makes India a much more predictable and frankly attractive place to do business.
So, we know what the provision does. Now let's get into the specifics of who can actually use it and when it applies. The details matter here.
The applicability is actually very straightforward. It has 2 main filters. First, the taxpayer, or what the law calls the assessee, absolutely must be a non-resident. Second, they have to be engaged in one of those 3 specific businesses we just talked about: mineral oil services, aircraft operations, or shipping. If you check both those boxes, Section 61 is for you.
Now here's a crucial point. Section 61 isn't just some alternative method. It has an overriding effect. What that means is it completely replaces the standard detailed process for computing business income that's laid out in Sections 26 to 54. You basically get to skip that entire chapter and just apply the deemed percentage. That's exactly what makes it such a powerful tool for simplification.
The theory is great, but let's make this real. Let's see how this all works in practice with a simple, clear example. So here's our scenario. We've got a non-resident international airline. In a tax year, their gross receipts from Indian operations come to 20 crore rupees. The question is pretty simple. What's their taxable profit under this new act?
And this just perfectly illustrates the simplicity of it all. Step 1, Identify the gross receipts. That's our 20 cores. Step 2, grab the deemed profit rate for aircraft operations from our table, which we know is 5%. Step 3, just do the math. 5% of 20 cores gives you a taxable income of 1 crore rupees. That's it. No need to track every single expense, no complex allocation formulas, just a simple, direct calculation.
The calculation itself is easy, but as with any tax law, there are compliance details and potential traps you need to be aware of. Let's look at what you really need to keep in mind.
Okay, let's walk through 4 critical compliance points. First, and this is absolutely crucial, always check the relevant Double Taxation Avoidance Agreement, the DTAA. The treaty might offer an even better rate, and you have to advise your client on the best option. Second, remember the big benefit here, a much lighter compliance burden, often meaning you don't need extensive bookkeeping. Third, a taxpayer can claim their actual profit is lower than the deemed rate, but be aware of the trade-off. Doing so automatically triggers a mandatory tax audit. And finally, always be careful to correctly identify and add up all gross receipts from Indian operations, as defined in the Income Tax Rules 2026.
So to put it another way, here are the big mistakes you want to avoid. Number 1, don't miscalculate your gross receipts. Number 2, always compare the tax you'd pay with the DTAA benefits. You could be leaving money on the table. And number 3, never ever forget that if you claim lower profits, you must get your books audited. Overlooking that is a huge compliance failure. All right, we've covered a lot of ground. So let's pull it all together and just summarize the key things you really need to remember about Section 61.
So here's Section 61 in a nutshell. First, its main purpose is simplification, taking multiple old provisions and putting them in one place. Second, it works on clear, fixed rates, 10, 7.5, and 5%, which makes tax calculations super predictable. Third, this all leads to a much lighter compliance burden for everyone involved. And finally, it does offer a little flexibility, letting taxpayers declare lower profits, but only if they're prepared for that tax audit. So I'll just leave you with this question to think about. As tax professionals, take a moment. Which of your non-resident clients in shipping, aviation, or oil and gas could really benefit from this simplified regime? This is a tool that's designed to make their life and your life a whole lot easier.
And that's our breakdown of Section 61. Thanks so much for joining me today. If you found this explainer helpful, please show your support by liking, subscribing, and sharing it with your network.
And just a quick disclaimer, this explainer is for educational purposes only and is not professional advice. Tax laws are always subject to amendments, so please be sure to consult your professional advisor before taking any action. This is an AI-generated educational explainer.